Haig needs a 2-putt bogey to win here on number 72 at the Rusty Putter in St. John. Ooh. He zips that one past the hole, and with that tap in, another 3-putt puts Haig and Perri score through 72.
Never gets old, Perri.
It never gets old. We're getting older.
Yeah, my hairline's leaving me.
I'm almost looking like the guy in the other corner on here.
Whoa.
Uh-oh.
We're
He's gonna be handsome.
We got the full Perri operation here, the Perri Senior grouping. So we got Tony Perri Senior on here today to talk about mortgage hacks for mortgage families.
Mortgage hacks.
Yeah, everyone loves to hack it up on a golf course, hack up life. We want to hack how to open this water bottle, all that stuff. So let's talk about a couple scenarios that my dad's done for my siblings because he likes them a little bit more than me, and how they've used those opportunities to get a couple houses.
Can't blame them.
Man, I'm not the most likable guy in the world, Just ask our 2 viewers. So I think one of them we'll kick off, right? So some people that watch do know my little brother. Nick goes nursing school, becomes a nurse, and flips around and decides he wants to become a nurse anesthetist, and he needs to move to Winston-Salem, North Carolina to enroll at Wake Forest, right? Well, what do you have? 2 options, right? If you're going to go away to school, you can find a place to rent, or you could potentially find a house to buy. Well, how do you buy a house when you have $0 in income?
Yeah, it's all potential income, right? It's nothing on paper.
You call Dad.
So
No.
A little known, not often utilized trick is that on a primary residence purchase, you can have a non-occupying co-borrower on conventional and on an FHA loan. Works all the time. The only 2 that you can't have a non-occupying co-borrower on, VA and USDA. So you have an opportunity, if mom or dad want to help out on FHA, your minimum down payment's 3.5%. On conventional, 5% to have a non-occupying co-borrower. So in Nick's case with my dad, right? I think they were looking at townhouses that were maybe renting for $1,600, $1,700 a month, and they buy a townhouse, and what was the total housing expense on was what, Dad?
$800 a month, and we paid about $110,000 for it in 2018. He had it for 4 years, and he sold it 4 years later for $210,000. So he had $100,000 to put down on his new house, and he actually had a job that paid him 6 figures. So it worked out very good for us. As a father, I got to help your kid learn how to manage a mortgage. We only put 10% down. We'd have to put 20 or 25% as an investment property. So it really worked out well that way, because when we sold the house, he gave me my $12,000 back, and he kept the other $100,000. So he had a nice downstroke on his permanent home. A lot of people don't realize you can do it, but I suggest it all the time. If your kid's going away to college, why rent when you're going to pay $1,500, $1,600, $1,700 a month? And a lot of these smaller college towns, you can buy a house for $100,000, $200,000. Watch the appreciation grow over 4 or 5 years, whether in school.
And your kid's going to have like 4 friends for roommates, right? Like it's not like you're not going to get your rent unless they're just going to be friends.
Right. No, instead of paying $50,000 a year for Wake Forest University, I told them I'd take care of the housing expense for the next 3 years. So I got out cheap, $800 a month compared to $4,000 a month. So he paid for his college, I paid for housing. And a lot of parents are in the same boat. Who wants to keep signing loans for everything you can do? But real estate, you don't mind signing that loan because you have an asset backing it. You don't just have a degree backing it.
Yeah, that's genius.
Little known thing, right? And it doesn't work. You don't have to, from my brother's perspective, you don't have to not have a job. You could also be, and we've done this a lot of times, a startup insurance agent, right? Where your primary income is going to be commission, and most loan programs require 1 year to 2 years of commission. to qualify. History of commission to qualify. Attorneys, same thing, right? It's building, it's offsetting your debt with mom or dad's income. On FHA, it has to be a immediate family member. So mom, dad, grandma, grandpa, brother, sister, uncle, aunt, mom-in-law, dad-in-law, that all qualifies to be that person. And as we kind of go through this concern with some affordability issues right now, and we're seeing what rents are going up to. Mom and dad, I think, might be a little more willing to chip in to get you out of the basement.
Well, I mean, let's talk about the rent thing for a second. I've done a couple investment loans in the last 3 or 4 weeks. If we're charging them 8% or whatever, high sevens for an investment loan with 25% down, they want a return on their money. Rent's not getting cheaper. More people are getting to become investors, so they're entering at 8%. Well, if their rate's 8% on 200 grand and their taxes and insurance, if you're in Cook County, through the roof all of a sudden, you guys' rent's going to go way up. It's way better to figure out if you can get. I structure it when I meet with customers, even if you're a co-signer temporarily, co-sign for a year, be a non-occupying co-borrower for a year. The person's income stabilizes, they get their promotion, whatever they get from being a resident to a permanent doctor, whatever it may be. There's a lot of different ways to be creative on getting into a house, but the cost of waiting is far greater than renting. Trust me on that. I mean, if you could put 5% down, have mom and dad or aunt and uncle, grandma and grandpa help you, and a year later we have the free refi. We refi the co-signer off of it, so they don't feel like they're handcuffed themselves for the next 30 years. You got to have an exit strategy also. It's not just entry. Have an exit strategy. With Nick, we knew he was going to be down there 4 years. It ended up being 5.5 because he went to college for 2.5 years. His wife went to college for 2.5 years. They both got their nurse anesthetist degrees. They both got great job offers, and we sold it. That's your goal. You don't want them to go down there and study whatever, party 101. But if you have a responsible kid, do it. If you have a kid moving from, I have one right now, a young family is moving from Virginia back to their Chicago roots, but the wife doesn't have a job yet. The husband does. They don't qualify for what they want, but if the wife gets a job, they will. So mom and dad are signing for them. In a year from now, rates come down 0.5 point or a point. We refi them, take mom and dad off. His wife has stable income.
And not to mention what you did for his credit. I mean, having that credit history and that account and that mortgage type has to help, I would imagine. I'm not a credit expert, Junior. That has to do something for them, right?
That's big. Your mortgage in the weighting on credit score, mortgage is the creme de la creme. It's the top of the ladder for weighting, right? Getting a mortgage is going to drive up your credit score a little bit, right? And then paying on that mortgage and performing going to trampoline your score, right? But the same goes, you miss a payment on a mortgage and it's way worse than missing a credit card payment. But I think it's an easy way to ease into home ownership too, right? Like you got mom and dad or grandma and grandpa, someone's already done it. They're there to kind of guide you through and make sure that you're doing it all right. I think I wouldn't lie. Having a test run is never a bad idea. Go ahead, Dad. Are you about to say something?
You talking about the mortgage or them living together?
Oh, them unliving together.
Oh, okay.
You want to get that kid out of the basement, right?
That was my goal.
Adam, I know your kids are young, but I know you want to drive them out of the basement already.
Yeah, we got to finish the basement first. I just got like.
So we can talk about another family situation where we did it with your sister. I happen to have a bunch of money in a retirement account, and no one was taking. They wanted this house really bad, and the realtor's like, "Well, if you made a cash offer, you're going to get it because it needed some work." Explain delayed financing. So I bought the house for cash. I wrote my.
Well, you didn't buy the house for cash. So
Pardon?
With delayed financing, and I think it's as in the market inventory continues to shrink, and good properties are going like this, and you're competing with cash. There's an opportunity for this program called delayed financing. it's pretty self-explanatory. However, it's a little confusing. So in the case of my sister and brother-in-law, who, my brother-in-law casually called Adam yesterday afternoon and had some fun things to say, but nevertheless, my dad wrote them a personal loan, right? So not a mortgage, wrote them a personal loan at 0% interest for whatever the purchase price of the house was, $250,000. I don't even remember what they bought it for, right?
Right.
So their offer is cash, right? Because dad's cash is coming in via a personal loan. Now, we're not going to comment on the tax implications and the gift implications and all that. Call your accountant and talk to them. If it's that much of a concern, charge the IRS minimum interest rate, which I think is 4.95% or something on a loan. But they buy the house, right? They buy it cash. It goes into Julia and Trent's name. Inside of 6 months, they can refinance that property, use, in their case, they need to do some repairs to it, refinance it, use the current value, not the purchase price, use the higher value now that the repairs are done, and take a loan out to pay my dad back.
So in their case, they did a bunch of stuff, and they did I think their appraisal came in where they're at 75% loan to value, so they didn't have to have PMI or nothing. And I pretty much fronted them 85% or 90% of the money. Or 100%.
So that loan, there's no payment in their DTI calculations. It doesn't.
Now when dad's doing a personal loan.
Yeah. So on the personal loan, like on the front end of that piece, there's not really any qualification. But again, it comes back to the earlier situation of having an exit strategy. So, okay, we know that you guys are going to owe $210,000 at the end of this transaction. What do we need for income to qualify? What do we need your debt to income ratio to look like? All of that. All right. So we know going in, yeah, they're going to qualify for a $210,000 or a $250,000 loan when the time comes where they need to return his money back to him. And then you're going to go through the standard mortgage qualification process.
Yeah.
The biggest piece of the puzzle, like my sister and brother-in-law had an opportunity to buy a house that was a single, the guy built it in 1970. They lived in there their entire lives, and they were not going to be able to compete because this is one of those houses in a subdivision where one house comes up for sale every 6 years.
Yeah. Probably dated too, right? Like older couple, they take care of things.
Oh yeah, it had wallpaper in every room.
Yeah.
Wallpaper down in my housewarming gift to him was painters.
And it's probably an insurance agent's dream, a wood shake roof.
Oh yeah, those are terrible.
Yeah, I think they're about $100,000 to replace with the synthetic wood shakes now.
Mm-hmm.
Yeah, they had to do that.
You guys is there a special insurance endorsement for those types of roofs, Adam?
No, you just got to make sure you got it insured for, right? Because a normal roof is on a house like that, it's probably 15 to 20 grand. But then you throw the shakes on there, you're getting up to 100 maybe. It just depends on the size of the roof.
Yeah, it's synthetic ones are expensive and timely, but it's just it's another alternative, right? We've been talking for ad nauseum since the beginning of the year about time value of money, money value of time, and a restricted inventory environment, right? Yeah. So this is the difference between when you call us for a mortgage. This is the difference between us and calling a call center that advertises a great rate that you clicked on, that they don't talk to you about the fees and all of that stuff, right? It's a family that's executed this stuff. This is like, if I'm talking to Adam about insurance and Adam says, this is how I insure my family, I'm going to take his word for it and go, if a pro is doing it like this, it's probably a good product, right?
Yeah. And there is, so we're talking about legacy and kids and real estate. So check this out, that we just did this for one of my customers. So wealthier family. So a father is concerned about what he's going to leave for the kids. So that's something that enters our minds at a certain age.
Sure.
So what he did is similar situation. Let's call it a $250,000 home. So he purchased the home. It is in his name, cash, right? But the kids are paying him a rent. That rent is now going into a whole life product that is getting a healthy tax-free interest rate with a tax-free benefit when they pass. So when he passes, they'll get the stepped up value in the real estate in addition to the death benefit on that life policy, but since he owns it while he's living, the cash that's in there he can play with. So it's almost like a everyone wins type of thing. So just all kinds of cool concepts that you can do with when you couple real estate in the financial world and with people who know what they're talking about, you can really kind of make some strides and with the goal of, cutting the government out of their taxes. Hopefully they're not
Yeah.
listening.
That's a good point, Adam. People don't realize that I've done in the last 12 months 2 reverse purchases.
Yeah.
So people are 62, 65 years old. They don't want to have a mortgage. Their income's, quartered, right? Because they retired, but they have $1 million, $2 million in assets, whatever. And they want to buy a house near their child, right? Just do it with a reverse purchase. You can buy the $400,000 house, put 200 grand down, have no payments for the rest of your life. All you do is pay your taxes and insurance, and you can live with your kids. If you raise your family the right way, hopefully the kids are financially stable. They're not waiting for you to die to get $1 million or $2 million. My goal is to, use all my cash and let the kids have to deal with selling all my real estate, right? I want to enjoy my retirement. I'm 5, 6, 7 years away, but I'll guarantee I'm going to get a reverse on one of my houses just to have it, because you don't have to draw on them. You could just get a reverse mortgage like a HELOC and just to have it. If I want to go out and spend 200 grand on a new boat or a crazy car because I'm in a midlife crisis, I can. But
So that money, that equity just sits there, or just so you can draw on whenever. Does it continue to appreciate?
4% a year?
How much?
4% a year. So if you open it up, say your house is worth 300 grand.
Okay.
You give me $100,000 line of credit every year. It's 104. Then 4% of 104 just keeps capping up. Unlike HELOCs, when the market crashed, I was in it in 08, 9, and 10. Everybody shut their home equity line of credits off. The banks closed them down, right, because values were declining. These don't decline. They don't shut them off. They're there until you die, right? And let's say I only use 100 grand. My house is worth 400. Most people think, oh, the bank's going to take your house. No, your estate has 6 months to settle the mortgage, which is 100 grand. So basically sell the house, pay off the 100 grand. They got the 300. Everybody thinks, oh no, it's backwards. Well, some people live till they're 95, 96 and they do become upside down, right?
Yep.
That's okay. Your family still has a right to buy that house for 10% less than current market value. And that would satisfy the mortgage. Or they can just say, here's the keys, Mr. Reverse Mortgage Company. We're done.
Yeah, there's no recourse against the estate.
No recourse against the estate. It's an easy exit strategy. But people don't realize that when you're talking financial tools, if I got a reverse instead of a mortgage and I put the other $200,000 in a whole life policy like you were describing before, I have the real estate that's still appreciating. I have the insurance policy that's growing, right?
Yeah, and then you got that tax-free nut when you pass away, like.
Correct, and I have cash flow that I'm. My house has paid my insurance, so I don't have to worry about writing that check for $300 or $400 a month to keep that insurance policy alive.
Yeah. Some cool strategies. It's just I think a lot of people get afraid to talk to someone for some reason. I don't know.
Well, inevitably we're all going to die, right? So if you don't have an exit strategy, you're living in a dream world. We're going to exit this world, right? So be organized, leave your family without having a lot of stuff to deal with and hassle with. Talk to them about it. I mean, my kids flat out know. Look, the biggest problem I'm gonna when me and your mom are gone is you guys have to sell the real estate.
I talked to my parents about that. Like, so I think of that generation, there's this pay off your mortgage so you own it. Like, I don't want your house, Dad. Like, I just don't. Go reverse mortgage that, or hell, at night you go grab a regular mortgage and spend the money and then pass away and give it back to the bank. I mean, I don't know.
Yeah, right. I mean,
people live and don't, I think that generation, a lot of them sacrifice living in, we talked about this with Bill Bloom a few times. They work their entire life away to where you have an opportunity where every day could be a Saturday, but you don't enjoy anything. I mean, I think, Adam, I know you spend a lot of time with your family. You guys love to travel. My family, we're currently traveling, right? Like it's letting your parents live like that. But how does that happen? Well, the only way it happens is if you take your income and you mitigate your taxes and maximize flow.
Yeah.
Easiest way for a lower middle class, upper middle class, less far below the 1% or the 0.01% to get to that spot is real estate.
Yeah.
Right.
Borrow responsibly, right?
Doesn't mean you can't lose. You can definitely lose on real estate, but given enough time, it's pretty hard to do so.
The real estate bounces back. It's like a helium balloon, right? It'll go down. Someone puts a little more helium, it goes back up. We're in an area where it's nothing but Airbnb type homes. It's called Watercolor. Very, very nice area. The values are finally falling. It's weird. They fell in the last year here.
Yeah.
But if you look at the history of the area in 2020 and 2022, those 2 years, they appreciated 45%. So too fast, right? They went from 500 square foot to 1,000 a square foot. Now they're coming back down to 700 a square foot.
What if you look from the 08 thing to 2022? It was pretty flat though. It was like making up for it.
No. 08 to 08 was the only year more, or 9 and 10 is the only 2 years values dropped. Other than that, it's always been a vertical line up. But when you're in a hot area or community that just starts rapidly appreciating, the problem, it goes so far high, then because everybody's overbidding, right? Then all of a sudden rates go up to tamper it, and then they start coming back down. They're not dropping massively here, but they're dropping almost back to somewhat affordable level if you want to Airbnb it or whatever, rent
you guys
it
on
out.
the same porch right now or different porches?
Pardon?
Are you guys on the same porch right now? Or you're on different porches?
We're on different porches. I'm in we rented a house where I was telling you we were at.
Yeah.
Yeah, they're all big. They're all 5-bedroom, 6-bedroom houses. Nice. Yeah, I mean, as a father, it's your dream, right? You got all 3 of your children, all your all the children's spouses, and 4 grandchildren, and 1 pregnant daughter-in-law with you. So, but the house is big enough. We have our space. We got little kids' pools. We got the beach. We got whatever. We're taking, we got the kitchen. So when little kids get hungry, realize there's 4 and under here. So when they want to eat, it's like, we're eating now.
Right.
You're not staying wait an hour.
We want as many chicken tenders as possible.
Yeah.
I love the chicken tenders. But I think that's the last piece on this. So, when you look at what people spend money on in budgeting, right? Can you figure out a way to maybe not go, buying a timeshare versus buying real estate where you could vacation Airbnb it too, right? And I think my parents have come down here 3 or 4 years, and it's like, okay, if we're going to continue to come to this place, try it out, we like it. All right, we're going to keep coming. It's got all the amenities that we want. All right, maybe it makes sense to buy a place here.
Yeah.
Is buying a timeshare, spending $15,000 to go to Disney. Like, that Disney trip, it might make your kids happy for a minute, but it sinks a hook in them. And next thing you know, you're burning $15,000 a year going there.
I mean, 15's a little cheap for Disney. I've been.
I haven't done it yet. So
get ready, buddy.
All right. I might need the reverse mortgage to take the family to Disney. But, no one complains about paying $200 to go to a park and see a mouse.
No.
Yeah.
But you got to be wise about it. But real estate, you're never going to go wrong with. When I was 21, I owned 9 houses, but I bought in terrible areas. That's not, people are like, oh, let's just buy cheap investment houses. Those don't always work, because those cheap investment houses, you get cheap renters and you get bad tenants, and it just turns into a disaster. I believe if you're going to rent out property, you should be in at least, lower middle to middle class minimum, and have a plan with it. I mean, is it something you want to use yourself? Is it something that, maybe one of the kids are going to be able to grow, move down the street from you in 10 years when they grow up and get a job? You have to think that way. And while you're young and you can swing the down payment, buying real estate, best investment anybody could ever make.
Strong words.
Strong words, strong man.
Well, I think one of the things we could talk about real quick too, as far as like rental real estate goes, Adam, on insurance policies there, right? It's one thing that your group really advises landlords well on, is all of the risks that you need to mitigate via insurance, right? And the actual cost of it, though, like, there's really, it doesn't, an extra $15 a month is way better than $100,000 problem, right?
Yeah,
What's some things that you ran into?
there's two big like gaps potentially on rental properties. Most people don't realize it, like ordinance and laws like an endorsement you got to add. So a lot of these houses are maybe a little bit older, but you have a little kitchen fire, and then all of a sudden your electrical and your plumbing's not up to code. Well, it might be $20,000 to bring that up to code to pull the permits. If you didn't select the right coverage, that's coming out of your pocket, and all of your net profit that you were supposed to have is gone. And then the other thing is make sure that you require renters insurance in your lease, because on a renter's policy, if they cause the fire, you can use their policy to cover all that stuff and keep your rates down. And plus, it's just a good thing to have as a renter anyway. But yeah, you're right. I mean, you can make the wrong decision, save $15 and cost yourself $100,000. It's no fun.
That'll quickly deplete the rainy day fund, right?
Yeah.
What's even crazier on like these Airbnb rentals down here, I was noticing outside the place, they have these little silver boxes. They're sensors for noise. So if you get too loud a party or something, they get notified so they can come over and quash the problem before the police come or the association gets involved.
Yeah.
A lot of communities in Florida have associations that have very strict laws about Airbnb. I know we have a place over by the chain of lakes, and we have a friend of ours. What did it take Mark and Doria, Tony, 6 months to get their Airbnb permit or ability to rent? Wow. Be wise on making sure you can get that sooner than later.
Right.
Yeah, it's a lot of. I mean, the city of Chicago has banned short-term rentals too, so I think that part of that game has continued to drive off, or it's not drive down, but maybe put a little bit of a lid on some price appreciation. So between that, restrictions there, rates kind of being a little elevated, the necessity for a larger down payment, and just the general higher cost of living, you need to hack a little bit, right?
Yep.
We talk about rent real quick, and the ability to afford a house and all of that. I have customers right now, they live in Crete. Their corporate landlord, right, the place owns 10,000 houses around the Chicagoland area, said, we're done renting houses in Illinois because of municipality ordinances and keeping all these houses together. Well, their rent's $28.65 a month. Their mortgage payment on a equally sized house is going to be $2,300 a month with taxes and insurance.
Yeah.
It's still, even everyone's worried about interest rates. Everyone's worried about all of this, home values, they're going to crash. Mortgage performance still all-time high. Rent, there's just such a murky data reporting, but I know it. I know, Adam, your office, you guys are dealing with people all the time that tell you what your rent payment, their rent is, and you almost fall off a chair.
Yeah, but seniors, right? Rent's coming up. I mean, these mortgages that they're buying into 2-3% more. As the inventory turns over, I don't think it's even gotten close to what it's going to go up to. I don't know what you think, senior, but
I think it's going to keep going up, Adam, because you have two things. You have an 8% mortgage. Now, you got these investors that want to buy properties fast. So we have this new loan out there called debt service coverage ratio. If the property cash flows, we give them a loan. We don't even look at their income or their job history. We just, put 25% down. The property cash flows, we give you the loan. Well, these loans are becoming the 2008, 2009 stated income, stated asset loans that basically put a mirror under your nose. You fogged it up. Boom. So that's because money is getting easier to get for not as well qualified borrowers. Everybody wants to get into the rental game. So you're going to have some landlords that never been landlords before buying 2, 3, 4 investment properties just because they cash flow. Then they're going to make the mistake of saying, well, guess what? This one community, I'm not going to name names here. The prices are only $120,000 for this 3-bedroom, bath and a half house. I can Section 8 it for $1,800 a month. That thing's going to cash flow. Then all of a sudden, what was the house in Glenwood, Tony? You had a customer, Glenwood, where the taxes went from $6,000 to $14,000 in 1 year.
Sounds like Dalton to me. I don't know.
Well, the mayor is having a great time over there. So.
Whoa.
That went up so they could get their police cars back. They repoed their police cars.
Yeah. What the heck?
Know the communities you're buying and know what your tax implications and future tax implications are going to be. If there's not industry in a community, more than likely you're going to have very, very steep increases in your taxes. You know, I used to play, my kids played baseball when they were growing up. We used to play in park forces, park district league all the time on tournaments and stuff. Great community. The average tax there in a $100,000 house is 11 grand. There's zero industry in that town. Zero.
Wild. It is wild.
Yeah, people like it's not always price. You got to look at the tax. You got to look at the industry behind the community if you're going to become an investor, because you can't. Houses just can't support a whole municipality. They got to have some type of other industry that has helped support it.
Yeah. Cool. What's on the end of it for you guys? A little golf, a little beach.
I think we're gonna golf tomorrow morning. Probably do the beach. The kids found they like diving into the swimming pool head first. The
That's nice.
3-year and the 4-year-old, so they did good with that. And we got 2 little babies that just kind of float around these tubes. Grandma and Grandpa watch them, and the kids go play on the beach with their kids. And we're fine. Just a nice, April's a great out to good fight.
We gotta love about this place. They got Vegas prices at the pool.
Yikes.
Well, Tony Senior, any other parting thoughts here? We've covered a couple ways that you've utilized some mortgage hacks to help out your non-mortgage kids.
No, just work with someone that's a professional and actually discusses an exit strategy. I don't care if it's your first home or your last home. What's your exit strategy? Because ultimately, you're gonna either disappear from the earth and someone's got to sell it, or your family's gonna grow and you need to sell it and get bigger, or your family's gonna shrink and you need to sell it and get smaller. You have an exit strategy. I don't care if you say it's your forever home; it's forever for a while, right?
Forever till it's not.
And if your mortgage professional doesn't ask you that question, call me or Junior. We'll ask you that question.
Great advice.
All right.
That's all we got, I think. Adam, you're out next week, but I think we got the Osting group. We're gonna do a little Kentucky Derby preview. So
Awesome.
tune in for some fancy hats.
Gotta hit that trifecta. Trifecta box.
Hey, you need a down payment? Follow our tips.
Oh boy.
Yeah. Right. Don't do that. You won't have your down payment.
All right, we'll see you guys next week.
All right. Take care.